Good afternoon, everyone. Thank you for joining in. I am Ankit Kanodia, partner and co-founder SmartSync Services, a SEBI-registered investment advisory firm. And today we are into our third guest webinar for Mission Smile. And a special thank you to Mr. Jatin Khemani for agreeing to do this in a very short period of time. I would request everyone to be on mute so that we can have a seamless experience and conversation and learn together. Jatin has been in the Indian equity markets for over a decade. He is the managing partner of Stalwart Advisors LLP, a SEBI-registered independent equity research firm. In 2017, he co-founded Indian Investing Conclave, IIC as we popularly know it, a platform we all know very well. Since its inception, IIC has conducted 150 plus sessions with close to 85 fund managers all across the country. And the best part about these IIC sessions is that it is online and anyone can watch it from their home, right? Jatin is also a CFA charter holder, an MBA in finance and BCom honors from Delhi University. That was his formal introduction. I would also like to say a little about my personal interaction with Jatin. Even though Jatin and me are almost the same age, I consider him a senior when it comes to investing. He has been very helpful to me whenever I had any doubts on any topic, whether it is investing or non-investing. Even for this event, I just dropped him a WhatsApp message and he instantly said yes. So thank you so much, Jatin. I'm very excited and confident that our Mission Smile family is going to get a lot of value out of this session. I know we can do a session separately on your own investing journey, but maybe that's for some other day. But it would be great if you can share a few special incidents or learning from your journey as an investor, because it will motivate our Mission Smile family members too. With this, over to you, Jatin.
Thank you, Ankit, for the kind introduction. And I welcome all the Mission Smile members to this webinar. What we'll do is I'll share my presentation. I'll talk about the agenda for an hour, and then we'll open for Q&A. And also, as Ankit said, in between, when I finish my first part of the presentation, which is about the investing framework, after that also, if you have any questions, I'll be happy to address them in between the session. So just some formal disclaimer and disclosures. The content of this presentation is not to be construed as an investment advice. These are my personal views. My firm, SEBI, my firm Stalwart Investment Advisors LLP is a corporate body registered with SEBI as a research analyst, and we could have ownership in the stocks we discuss in this session. They are purely to illustrate our investment process and more like a case study format. The views can change, so I request you to not act on it and unless you do your own due diligence. These are some other mandatory disclosures as per SEBI research analyst regulations. It's a long slide and I'm not going to read this out. Essentially, it says that other than the ownership financial interest in the company, we do not have any other relationship with the companies discussed in this session. So with those boring disclaimer and disclosures out of the way, let's jump into the session. This Ankit has already covered, but I'm going to just share briefly about how IIC came into picture. So I consider myself extremely lucky because in my brief 11, 12 years of investing, I was very fortunate to be in the right company, to have some amazing mentors, to have some amazing circle. And I was very fortunate, you know, at a very early stage in my career to participate in forums like Flame Investment Lab in Pune, in October Quest organized by Parag Parekh Mutual Fund in Mumbai. Then CFA Society does Value Investing Pioneers Meet in Delhi. Tamil Nadu Investor Association does TIA 2020 in Chennai, so on and so forth. These are prestigious forums, but they are physically conducted and are restricted to 100 people, mostly by invite. And I would often travel to such places, spend few days with these veterans, and I would learn a lot, much more than you can do by reading books on just be on your own, because they have decades of experience, and when you spend time with them, the knowledge sharing is just unbelievable, right? So back in 2016-17, I thought uh, the technology has enabled so many things in our lives, has made so much things so much easier. Why not leverage technology to let this wisdom, which is otherwise confined to a boardroom, let it flow to masses, and they could they could learn from these guys sitting at their home or offices. So that's how the concept of IIC uh, struck me. And now with COVID, everybody has gone online, right? It's no more a choice, it's a compulsion. For 2 years, we have been practically locked down in our houses. But IIC has been pioneer in this. In last 5 years, as Ankit shared, we've done more than 165 sessions now, uh, 30 without a paywall. And even where we have been charging, we've been trying to uh, channelize a part of proceeds to some really good causes with whom I'm personally associated. We have channelized over 8 lakhs in last 5 years to these causes. Uh, the other differentiating part is that rather than keeping the format open where you know instructors are talking about anything under the sun, we have tried to keep a format where it is very practical, unless as opposed to theoretical. So each instructor talks about a specific listed case study in which most likely he or his fund is invested, she or their fund is invested, and then they explain their investing process through that live case study, which will also be the format of my presentation today. Uh, so it has been very fulfilling as facilitators for creating this ecosystem, because as one is the money has been channelized, a part of proceeds have been channelized into really good cause. But otherwise, hundreds of participants have keep joining us every year, and the kind of feedback we get is so fulfilling. The instructors are also very kind; they're happy sharing their wisdom, and they also get feedback in exchange. A lot of participants belong to those industries from which the company is being talked about, and even the instructors get a lot of constructive feedback. And obviously, it's a way for them to showcase their research capabilities, and a lot of participants end up becoming their investors also. So it's a very win-win kind of a format. Uh, Very niche, but something that has been fun putting together. So that's been the journey of IIC. Uh, in terms of my background, I've been relatively new to markets, 11 odd years. I started investing professionally when I was 22 years of age. And the Nirvana movement for me was when I read up these two books, One Up on Wall Street by Peter Lynch, and The Little Book That Builds Wealth by Pat Dorsey. Uh, Sometimes when you do something in life and it just rings a bell, a bulb goes on. That was the kind of moment for me when I read these two books. And also, I was introduced to the concept of financial independence by a book called Rich Dad Poor Dad by Robert Kiyosaki while I was still in my MBA. And the thought that you can be financially independent once your passive income is equal to or more than your monthly household expenses or whatever you need to survive was so liberating, right? That you don't need to work for money. You reach a stage where money starts working for you. And equities is just one way of passive income. You can have whole host of other streams of income coming to you while you sleep, or you just chase your passion, or just travel the world, whatever, so to speak. Uh, and then I worked two jobs under awesome mentors. The last one was in Delhi, uh, where I've been born and brought up and currently also based out of. So this job was for a large prop book. The directors were in the markets for more than 3 decades, rags to riches, from nowhere to hundreds of crores made in market. I was leading the research desk for this prop book. And then by 2014, I had option to move up the corporate ladder, go to Mumbai, join some larger institution, or be on my own. And I was too attached to my family to leave Delhi, leave them behind in Delhi. Also, being a Sindhi, the business was always in my DNA. Although this is not a business, this is a profession. One with a very high fiduciary responsibility, like being literally like being a doctor. At least that's how I look at it, because it's somebody's lifetime savings riding on your uh, research. So I started my entrepreneurial, my professional journey being on my own in 2014 by starting Stalwart Investment Advisors. And it's been 7 odd years, lots of ups and downs, but net, being able to generate more than 20% CAGR since inception. This is twice what market has generated in terms of the frontline indices, and also the top decile, the top 10% amongst comparable multi-cap universe. So that's a brief about my personal and professional journey. Uh, Before we delve into the session, I want to share what does really investing mean to us. And investing is a very unique profession in the sense it means different things to different people. Almost to everyone, it means something else. It's like it depends on what you want it to mean to you, right? What you want out of it, and whatever you want, it will give you. You want it, you want to speculate out of it, you can do that. You want to consider it ownership in underlying businesses, it'll mean that to you. You just want it to be a passive thing, it'll play that role for you. You want to be full time into it, you can do that. So extremely uh, exciting space, and I'll share what it means to us. Okay. So for us, stocks are not wild tickers which are just moving up and down. For that, I like to go to Delta Casino in Goa and have a nice time. I don't do that in markets. For me, it's not a wild ticker. I have never traded or leveraged in my life. Not to mean that those who do are doing something wrong. It's just that I want to drive something else from market. For me, it is extremely fascinating that I can have fractional ownership in whatever listed business I want. So I can have fractional ownership in Nestle, which I can't ever imagine recreating if I were to start it from scratch, right? Or a Hindustan Unilever, or a Maruti, or a niche chemicals play, uh, or an extremely regulated banking operation, right? So as an entrepreneur, I can't imagine starting these from scratch. And what skill set can you have to have start to start so many businesses, right? But here, sitting at home with whatever little amount of money or savings you have, you can have actual ownership to that extent in these businesses, uh, and thereafter write their growth story. It is extremely fascinating to me from the day I discovered this, and till date, the excitement has only risen. It hasn't they say time correction in life and in markets. That has not happened. With each passing day, the fascination has only grown. uh, our typical investment horizon is 3 to 5 years. You hear people talking about decades of investing, uh, uh, never sell and those things. I don't believe that. I am a very practical person. I believe even promoters don't have view beyond couple of years. We live in times which are where disruption is extremely high, uh, be it regulations, be it government policies, be it technology, be it the disruption through well-funded startups, be it the changing preferences and taste of consumers. Great businesses are created now overnight, and great businesses can be destroyed overnight. Uh, so it is very difficult to have a view beyond 5 years, in my opinion. At the same time, I don't mean that you have to keep selling every 3 years. It's a rolling view. So you keep rolling your view every 3 to 5 years, and as long as the picture is clear and the thesis is intact, you stay invested. So I've been invested into companies for much longer, but you keep reviewing them, and be very humble in the sense that anytime a disruption can uh, totally kick off the thesis, totally shake out the thesis. Our preference is to have owner operators, and by owner operators we mean uh, owners who are running their companies themselves rather than a professional CEO. अपना बच्चा होता है, right? When you own the company and you're running it, uh, you tend to think long term. Uh, you can bear short term pain for long term gain. You'll do what is right for the company because uh, you are the owner, right? You're not a professional whose life depends on the next bonus. The next is owner operators with skin in the game. Means higher the stake, the better it is. They should create wealth when the company does well, and vice versa. So your interests are aligned. As a minority shareholder, your interests are aligned with the owner operator. And finally, the business should have a robust balance sheet. And by robust balance sheet, I mean uh, both on balance sheet and off balance sheet liabilities should be in check. Ideally, we would prefer debt-free balance sheets, but even if there is some debt, it should be reasonably manageable, because a down cycle can always kill a business if it is fragile and loaded with a lot of debt. We are sector and market cap agnostic. So from chemicals to banks to IT to FMCG to discretionary to fast moving industrial goods, we have practically representation from most sectors in our portfolio. We are also market cap agnostic. So from 500 crores market cap to 10 lakh crores market cap, you would have such companies in our portfolio. Typically, we have 18 to 20 stocks in our portfolio, businesses in our portfolio, with allocation ranging between 3% to 10%. Uh, for us, this has been a sweet spot. Uh, ना ये बहुत ज्यादा कॉन्सेंट्रेटेड है कि 5 बिजनेस में सारा पैसा डाल दिया और उसमें से फॉर सम रीजन 2 उड़ गए तो आपके पोर्टफोलियो की बैंड बच गई, और ना ही ये म्यूचुअल फंड्स की तरह 50-100 बिजनेसेस लेके बैठे हैं कि each is so small that even the winning positions are not able to add alpha to your portfolio. So this is somewhere in between a sweet spot, I would say, where neither you are too concentrated nor you are too diversified. And each position has a very relevant role to play in your portfolio. Finally, we don't do market timings, which means we don't do active cash calls based on index level. कि यार निफ्टी 18,000 हो गया है तो अभी 20% पोर्टफोलियो बेच के कैश पे बैठ जाने का, या निफ्टी 15,000 हो गया है तो पूरा इन्वेस्टेड हो जाओ. We don't invest in Nifty, so market levels should not impact our ability to be fully invested or not, right? By nature, by philosophy, we are optimistic. We are bullish on India. We see as a country, as an economy, next decade or two to be really good for us. So we stay positioned for luck by investing in companies which will grow, right? And the idea there is to invest if you're able to find an opportunity and sit on cash if you can't, irrespective of निफ्टी 18,000 है या 15,000 है, राइट? अगर आपको बॉटम अप इन्वेस्टिंग अपॉर्चुनिटी मिल रहा है तो पैसा डालने का, नहीं मिल रहा है तो नहीं डालने का. There is no active cash call here with respect to index is what I'm trying to say. So that is what investing means to us in one slide. I've tried to cover a lot of ground here in terms of broad, top down, how do we try to invest. Now, what is our investment strategy? Investment strategy is never static, right? Every year, if you are agile, if you are humble, if you are adaptable, it will keep evolving with market. It will keep evolving with your own experience. It will keep evolving with what worked for you, what didn't work for you, whether you are smart enough to learn from your mistakes, whether you're smart enough to learn from others' mistakes. And what will happen is if you're agile, your investment strategy will also keep evolving. And I think it makes a lot of sense. You should not marry a style. Uh, Styles come and go in fashion. You should marry certain basic principles of investing, but not styles. And in last 11, 12 years of my investing journey, my strategy has also kept evolving. So today on 4th of June 2022, this is what our strategy is. I don't know how it would evolve further, but that is how it looks today. So there are two frameworks with which we are investing as on date. One is what we call Stalwart's 2020 framework. I've tried to simplify it as much as possible. बहुत सिंपल है जैसे IPL 2020 है वैसा ही अपना 2020 है. Uh, the aspiration is to look for companies, businesses which are able to grow their earnings at least for at 20% CAGR for next 3 years. As I said, उससे ज़्यादा का view promoter को भी नहीं है. So don't get into that uh, डिल्यूजनल एनालिसिस 2040 में क्या होगा 2050 में क्या होगा. वो एक्सेल स्प्रेडशीट वाला काम अपन नहीं करते, राइट. फॉर जस्ट टू फिल अ DCF अपना सेकंड डेसिमल पॉइंट तक अर्निंग्स निकाल दिया, डजंट सर्व एनी पर्पस. नेक्स्ट 3 years 4 years ब्रॉडली आपको अर्निंग्स डबल होता दिख रहा है, 18-20-22% CAGR का स्कोप दिख रहा है. इफ द आंसर इज यस, मूव ऑन टू द नेक्स्ट पॉइंट. How is the quality of that earnings incrementally or on the base earnings? Does the business make at least 20% ROC? Today, cost of capital is about 10-12%. Are you able to make substantially more than that, 18-20% ROC बना रहा है business या नहीं बना रहा? So with growth and quality of earnings, the third is what are you paying for this stream of earnings? If it's less than 20 times, you are essentially paying a very reasonable multiple to invest in this business. And when all three meets, it's in general parlance in our industry known as GARP, growth at reasonable price or quality at reasonable price. This is not something we have created, right? Our masters have been investing this way, and we have over the years learned from them and just tried to simplify by calling it 2020, right? Otherwise, this is nothing but what's popularly called as GARP. Growth because earnings are growing. Quality because it's a high quality earning stream. ROC is more than 20%. And reasonable price because you're paying less than 20 times for this stream of earnings, right? At any point in time, about 2/3 of our portfolio would tend to fit this. And by tend to fit this, I mean, doesn't mean 20-20-20. Earnings growth can be 16, 17, 18%, ROC can be 22, and we might have paid 22, 23 times. So it's not a science, right? It's an art. You can't fit everything into a mold. You have to be flexible, but broadly things should be in line. And there should be a checklist you should broadly be able to meet. In this framework, one very good example from our current portfolio is a company called SIS. And Ankit and Smart Sync has a coverage on SIS, I believe. So I assume most of you would be familiar with the company and excuse me, and also how it beautifully fits this framework. So you see last 3 years, 5 years, 7 years, this company has been growing earnings at high teens, anywhere between 16, 17 to 20, 21%. The ROIC has been about 18 to 20% on an average, and it's available at 20 times next year earnings. Practically a debt-free business, market leaders in India, they're 5% in security business, also growing very fast in facilities management, cash logistics, uh, and now leveraging technology to offer unmanned services at ATM, surveillance of pipelines through drones and whatnot. So they are 5% market share today, and by 2025 they want to reach 10%, and the industry itself is growing in double digits. So essentially they're talking about growing India business at 20%. And assuming margins expand or stay here, the profitability should also grow by 20% or higher. That ways, it fits the 2020 framework beautifully. The second framework is special situations. And the reason for having special situations in portfolio is because otherwise the markets have become extremely efficient, right? It's very hard to find opportunities in 2020 framework. The good quality growth stocks are very expensive. Uh, we are overloaded with information from YouTube to Twitter threads to investor presentations to con calls. We are bombarded with information. Gone are those days of 90s when getting an annual report used to take 6 months. There was a big information arbitrage at that time. It's no more there. There was also a big arbitrage for analysis at that time. People did not really understand ROC and growth at that time and valuation frameworks at that time. Even that is gone away now. So from usual growth framework, getting at reasonable price has become very challenging. Markets have become super efficient. With each passing day, it's getting more and more difficult to outperform markets and find opportunities. Unless you put bulk of your money when market crashes, like 2008, 2013, 2020 COVID crash. If you're able to time market that way, I'll save for 5 years and wait for one market crash, put all my money at that time and then forget. If you do it that way, you can outperform. Uh, but it's very difficult, right? And how many of us can do that? And you don't know when would the next crash come. And it's not easy to invest when the markets are crashing. You keep waiting, and by the time you invest and it turns. So that's very speculative. So, what is the other way to find some opportunities where there is still scope for generating alpha? Those are opportunities under special situation category. One is where management changes. There are some really good businesses out there, but which are run by managements who are either not too competent or who are not the best in terms of corporate governance, or where focus is missing. They have a lot of other businesses, and this baby is totally ignored, and so on and so forth. For whatever reason, the business is good, but the management is not. The horse is awesome, the jockey is not. So the minute there is a change in jockey, uh, you must consider such businesses. For example, just as a case study, some 4 5 years ago, we invested in a company called Crompton Greaves, and at that time their B2B business was struggling. Debt level was very debt laden, and they were in losses. And the and the attractive part of the business, which was Crompton Consumer, where they sold pumps, fans, lights, that was totally ignored. So when they sold it to a PE player, we invested in the business, and within a year there was so much re-rating, and so much earnings growth in next 2 years. We ended up doubling our money within a year. And then that eventually happened to the other part of the business also, Crompton Greaves, right? And there the returns have been even phenomenal. I think it's more than 10x from the time the deal was announced and the Murugupa group came in. uh, so when the management changes, it throws some really good opportunities, and the re-rating can be very swift. The same business in the hands of a competent management can be worth much, much more. The other is spin-off. When the attractive part of the business, so this happens in conglomerates on when there are unrelated businesses within a listed company. So, for example, in case of Suven Pharma, there were two businesses, very distinct. One where they were doing CRAMS for other pharmaceutical companies, and one where they were doing their own research called NCE, New Chemical Entity. And the new chemical entity was investing a lot of money, and with no revenues yet. From last 15 years, they've been investing tons of money every year, some 100 crores. And the cost of this investment was subsidized by the other business, Suven Pharma. So when they demerged Suven Pharma 2 years ago, we invested pre-demerger, and post-demerger, within a year, the stock went up 4x. From some 3,000 crores market cap, the company went to 12,000 crores market cap, and we ended up creating a lot of money in this process. So when an attractive business is hiding in a conglomerate and then gets demerged, generally the re-rating creates a lot of wealth. It's true in most of the cases, not always. And you have to also see at what valuation you're entering. because you could lose money in the other part. So net net, you have to see what the equation works. Then the third option is opportunity set of opportunities are from turnarounds and cyclicals. Uh, and I call them special situation because after 3, 4, 5 years of bad cycle, the markets just start hating them. And a lot of them trade below replacement cost. And then the leveraged players are either out of the market, they go bankrupt, they go into IBC, Insolvency and Bankruptcy Act, uh, and whosoever survives are generally efficient players, lowest cost producers, healthy balance sheets. And when the supply reduces and over the years demand catches up, next 2, 3 years are generally very good for cyclical industries. It's a seesaw, and you've seen so many industries this play out. So because the recent past is very bad, markets tend to value them very poorly. And that's why I call it a special situation, because if you're tracking the industry matrix and you're able to play that turnaround and upcycle, there is a lot of money to be made. The final set here is variant perception. Uh, Sometimes because of management decisions or business decisions, uh, companies go through such long patches of poor performance, they disappoint the investing community so much that nobody is willing to look at them. Nobody. And then when you come across certain changes which are extremely large and changing the entire quality of business, the quality of balance sheet, and the trajectory of business, if you are early in that cycle, eventually market will realize, right? But if you are early in that variant perception game, where market thinks ये कचरा है, but आपको पता है ये कोयले से अभी portfolio in such special situation basket, depending on how many opportunities we are able to identify, and the remaining is generally in the steady compounders or the 2020 framework, as I explained. So a really interesting example from the special situation basket today is a company called Usha Martin. But before I deep dive into Usha Martin, which will be all of my rest of the presentation, the next half an hour or so, we can take a couple of questions, Ankit. If you have anything, or if anybody else has any questions, I'll be happy to answer.
Jatin, I see a few hands being raised, but before I go to them, I have as in a very curious question regarding your wonderful framework. So I'm sure over the years this has been developed, and you would also had your fair share of mistakes as well in these frameworks. So if you can just share a couple of examples, maybe one from the 2020 and one from the special situation, whatever if it comes to your mind, where everything was see. What I could understand from my experience in investing is that even if you do the right work, even if you follow the framework, there will be times when luck is not your way. And you have to recognize that and then sell it and move on and take the learnings, right? So if you can share that, I think that would be very helpful for all of us.
Ankit, you'll need a couple of days for me to cover my learnings and mistakes here. There have been so many. Uh, it's I'm spoiled for choice actually. There have been so many.
So you can just choose one from each.
I think one which I think which is easy to explain is Wonderla Holidays. That's been a large uh, position for us for a good 7 years now, and we are still out of money on that position. Uh, Company has done everything right. In fact, we keep going back and seeing, could we have done something differently? What was our mistake really? And I go back in 2014 and I see I'll still buy this business at this valuation. Yeah, it looks great. Whatever he's saying makes sense. Opportunity is good. Balance sheet is cash rich. There's an owner operator, one of the best corporate governance in the country, one of the businesses with really good tailwinds, uh, no China competition, uh, stated policy of adding one park every 3 years. Existing parks are throwing so much cash. No new competitor can come in. Land itself makes it unviable today. So incumbents have a lot of advantage, so on and so forth. And 7 years, 8 years out, and you're still 20% lower on that uh, position, uh, tells you that there are so many externalities which affect investing. Forget us as a minority shareholder. Yeah, think about the promoters. They have done everything right they can, but first it was GST. पहले कोई सर्विस टैक्स नहीं था इस पे, 14% सर्विस टैक्स लगा दिया, फिर 18 कर दिया, फिर जीएसटी आ गया, फिर 28% जीएसटी लगा दिया, फिर डीमॉन आ गया, फिर कोविड आ गया. वन आफ्टर द अदर दे हैव बीन dealing with so many external challenges, and every time during this process we revisited and said what is going wrong, should we exit, should we move on, uh, but we did not. Yeah, so maybe we should have let a time stop loss hit. So one learning has been that if something is not working, uh, you can move on to other opportunities. There's so many opportunities, and you can come back when things start working for them. So shit will happen. That's why diversification is also important. That some positions did not work at all, and yet at portfolio level we have made more than 20% return. So some positions which are giving you 5x, 10x, there are these positions also which will be baggage, which will not make any money, or which in fact can go down 20, 30, 40%, even if thesis is intact. uh, is a lesson, right, on diversification, that it's a teamwork. Uh, you just don't need batsmen, you need bowlers, you need fielders. To win a match, you need a team, and everybody will do their job. You can't expect everybody to be a batsman and hit a six for you. Some are just fielders for you, some are just bowlers for you. Uh, and there have been hundreds of other learnings here in this last 12 years. In fact, I did a session for CFA Society a couple of years back. It's a nice 2 hour session, and I've listed a lot of my learnings with all real examples where I invested, things went right or wrong, what was the learning, and how we have inculcated them in our investing. Uh, Initially we got into really liquid small caps also, and I realized it's for prop money. You can't do that with uh, advisory or public money. There were some opportunities where we went up 10 times, tasty bite, and liquidity increased with time. But in some opportunities where things went wrong and liquidity actually decreased, then on exit the impact cost is even higher, right? It happened with us in Goodrick. We got the cycle wrong, and from 400 the stock came to 100, yeah, 150, and your exit then crushes the price further. So within small cap basket, we have got some companies right, but they were in sectors where headwinds were very large. So they also got derated for no fault of theirs. And then there is a small cap cycle of 2018-19 where even if your companies were doing fine, there was so much exodus of capital from that pocket of market that your companies also got derated, because whichever MF was holding small cap, he was just dumping it left, right, center. वो 2 PE पे आ जाए, 5 PE पे आ जाए, रिप्लेसमेंट के नीचे आ जाए, उसको नहीं फर्क पड़ता. उसको रिडेम्पशन है या उसका मैंडेट चेंज हुआ है, तो उसको पैसा निकालने का है. You know, there were so many other things which, as an advisor, you want to take into account now, because you are not managing prop money. You are answerable, and there are other investors on that side, and sometimes the down cycle could be 2, 3, 4 years, and you have to steady the ship during down cycles also. You have to control your drawdowns. So then we have added some steady large caps, mid caps. We started giving a lot of attention to tailwinds. We have started avoiding deep value stocks, businesses where there are no triggers inside. There, the opportunity cost of staying invested for 2, 3, 4 years could be very high. So you want to board those trains once they started moving, even if it's at the next stop or next to next stop, but they should be moving, which means it's okay to invest at 50% higher price, but when you're sure that it's doubling again in next 1 year, versus just buying at that cheap valuation, but then see it not go anywhere for next 2, 3, 4 years. So opportunity cost is very real, and you have to give it a lot of importance, whether it's your own money or public money, because money is limited, right? It's not unlimited. Whether you're managing 1 crore or you're managing 1,000 crores, it's a fixed pool. Opportunity cost will hit you, right? Even if you're not indexed to somebody else. So, and there are hundreds of more learnings here. I'll just share that session link, Ankit, and you can float it with
Yeah,
the,
sure.
yeah.
Sure, Jatin. And just to add to what you are saying, but while you were saying, I was just thinking about how we, as in Akhilesh and myself, we keep on discussing. Akhilesh is my partner at SmartSync Services. So we keep discussing about, so every stock, हर stock की अपनी कहानी है. So every stock will move in its own way. That is why we should always look at the portfolio as a whole, because like what has happened with say Wonderla, हो सकता है 8 साल 9 साल से it has not gone anywhere, but in 1 year it can become a 3x. You
Absolutely.
never know. You never know, and you have to be, and हो सकता है वैसा का टाइम नहीं भी आए, but you have to follow your instinct and understand the process. Sometimes some stocks will probably not give you the returns, but that is how you make majority of your returns on the portfolio, right? That is what you have to look at. So
You don't know it in advance ना. हो सकता है वंडर
exactly,
में 5x होता और कोई और स्टॉक 20% डाउन होता. आप यार
exactly,
एडवांस में तो बता नहीं सकते. आपके
right.
you have 3 kids who will become IAS and who will become a singer. Who knows? अभी तो you've just they've just come into this world. It's very difficult to predict, right? So that ways it's a probabilistic game, and as long as we are focusing on the process and not the outcome, it should take care of itself.
Right. Reminds me of that Warren Buffett's famous quote: in investing, the rear view mirror is easy to see, and windshield is always full of uh, fog and all. So I
Absolutely.
have one question on chat. I think this is from Jay. So it is related to special situation. It is a stock specific question. You may choose to answer or not based on your understanding. So, what's your view on India Bull real estate as a stock? It has crashed, but Embassy is buying this listed company, a case of reverse merger. So that is the question about India Bull real estate.
Yeah. So I think market is spooked with the 6,000 crore debt figure, which was not anticipated. At the time of announcement of merger, the Virvani Group said that the consolidated debt would be about 3,500 crore. The current figure is twice that. And the recent QIP has also been at a lower price, and there's been a lot of dumping, which is why the stock has crashed. But if your thesis was merger purely, and you're bullish on real estate cycle, to my mind, both of those are intact. I am very bullish on real estate cycle, both residential and commercial. And in this company, you get both. You get residential from India Bulls, and you get commercial from Embassy. Uh, and I think as a group with Blackstone on their side, this is a solid group to my mind. You look at their historical execution, the first REIT in the country, Embassy REIT, with Blackstone was done by this group. And they'll also have the first right, whatever new commercial property they construct. A lot of it is in the pipeline. Currently, the group is going through debt issues that is there, and that's why it's at this price. Uh, and the merger, the other part of the thesis is merger. I think we are almost there. Out of the two benches, the Bangalore bench is already approved it. I think the Chandigarh bench, the last hearing is left. Creditors, shareholders, regulators, exchanges, all other approvals are in place. Embassy already owns 15% of the listed company. And post the merger, they would, along with Blackstone, they'll own some 50 odd percent. So that ways, if your thesis was a real estate cycle to be positive and merger going through with a solid group running the show, I think that's intact. Debt is an added risk, but at this valuation and with this cycle and the expected cash flows from their ongoing projects, hopefully in a couple of years, this should be under control. That's my personal view on the opportunity.
Thanks. Thanks so much, Jatin. So I see Dhruv has been raising his hand for a long period of time. Dhruv, you can ask your question.
Hi, Jatin. Thanks for
Just to,
the.
sorry, Dhruv, just to
Yeah.
add to the previous question, Jay, this remains a very risky opportunity. It's real estate. It's a very obscure business. There could be a lot of things off balance sheet also, and things can go really bad in such circumstances. So if I were you, I would ride it, if at all, with a very low allocation. So you can manage risk at the allocation level here, if at all you want to invest. A lot of people would not even touch it. It is that risky. So with that caveat, I wanted to add that to my answer. Yes, Dhruv.
Yeah. Hi, Jatin. Thanks for the sharing your framework and your experience. My question, before I just ask my question, I'll just give my background from where I'm asking this question is, we all tend to have that recency bias when we go about investing. And over the past, at least since I've joined, I've been investing, or when I turned adult, it was, I've been seeing a cycle where the interest rates have been falling globally and in India. The question is with regards to that P multiple of less than 20, which you just shared. I'm deliberating, and I'm of the view that we are looking at an interest rate cycle from up cycle from here over the next few years or probably a decade, who knows. And in this, you mentioned a point of 2018-19 when there is an exodus of capital which happened, which butchered anything and everything in the small cap space. Where would you see there would be a margin of safety in the PE multiple? At what level? Seeing that the capital might not be going out, but it would be asking for a higher rate of return, or would be chasing something where there is more stability, where there are more assets, things like that. So how or where? I'm not asking you what a pinpoint level, but from your experience, because you guys have much more experience than me. But at what level, like a 10 P multiple, a 15 P multiple? Because this cycle, probably which we are going to see, probably 20 might also, in hindsight, might turn out to be very much more expensive, which, global FIs or FDIs or whoever might not be willing to give.
Dhruv, interesting question. Point taken. I agree with you what you're saying, but PE is just a shortcut, and it's a derivative of a lot of other factors. The quality of business, the quality of earnings, the growth profile, the balance sheet, how's the relative position of that business within that industry, how sought after is that industry overall, is there a scarcity premium, so on and so forth, right? So in some cases, even 15 could be expensive, and in some cases, even a 25 could be reasonable, right? But directionally, P's are compressing. That's a given. As your denominator increases, your discount rate goes up, your numerator is bound to come down. All assets will be repriced because your discount rate is going up. And also the liquidity which was chasing all these assets are also reversing. So from a technical standpoint too, the demand will slow down and supply will increase. That should also compress the multiples. I think more important is to know what to avoid here. Uh, uh, for example, all the so-called coffee cans of the world, I would not be there, right? I would not be willing to pay 50, 60, 70p for a 10% growth business. Even there, the way those businesses have been hyped by fund managers, they've done a disservice to their businesses. Look at what's happening to paints. From rooftop, you're shouting, it is a great business and market gives it so much multiple. Now your cement guys, wall putty guys, PVC pipe guys, everybody wants to be in paints. So that same 7,000 crore profit pool is gonna get divided between a much larger set. You ended up fragmented a consolidated industry. The whole capital employed in the sector was 7,000 crore and now one player is committing 10,000 crore to that industry, right? So by being too much visible, they actually did a disservice to their own portfolio companies. I would want to be in spaces where this industry is entering a good cycle. They are consolidating, and the earnings quality is not 50, 60% ROE, but it's reasonably good. It's high teens. And the growth is also not 50% because those are not sustainable growth rates, even if they are in some businesses. Reasonable high teens growth rate, and then any re-rating is bonus, but I'll be counting at least there is no de-rating, and whatever earnings growth comes translates to my stock return. That's how my expectation of investing at today's scenario is.
Got it, got it. And if I have some time to ask a follow-up question, taking that thesis forward, and when you talked about consolidation and chasing this without increasing the supply, and the whole turnaround cycle story that we are seeing here, this whole interest. My view is, and if you can correct me, I just want to ask whether that view is correct or not. As the interest rate cycle keep on rising, Ashwath Damodaran had said, I think way back in 2020, that people are not willing to give valuations, or they're not chasing any valuation to assets that have been built, like a steel plant or a cement plant or anything. They just start chasing growth, earnings growth, or whatever it might be, XYZ. Would you see with the rate hike in the interest rates, investors will start looking and saying, and okay, there's an asset which this guy has built, there has to be a value that has to be assigned to it, and you can't just look at just pure earnings. We'll have to start assigning values to assets, and accordingly asset heavy businesses might just get a sort of a re-rating irrespective of what is happening on the commodity side or whatever. Okay.
Dhruv,
Is that
if you had asked
possible?
me this question a year ago, I would have answered based on what I think. But today it's already happening, right? NTPC is at decade high. Look at steel valuation, where all these companies traded 2 weeks back. All the asset heavy businesses, from utilities to steel to power, has been getting re-rated, and a lot of them are at decadal high market caps and prices, if not valuation. So market has started valuing these tangible real businesses, these real stream of cash flows. Look at the way how commodities have done in last 1 year. So all of this is already happening. The sector rotation has been happening from last few quarters, and we are in the middle of it now. Market has already derated a lot of intangible businesses and re-rated already a lot of tangible businesses.
Okay, fair enough, fair enough. Thank you.
Welcome. Ankit, I suggest let me resume the presentation, and then we'll take remaining questions in the end. What do you say?
Sure, no problem, Jatin. We'll
Perfect,
or you
because
can.
I need half an hour. It's already almost 5. I'll need half an hour to cover Usha Martin. I don't want to cut time from this, and remaining time we'll take rest of the questions.
Done. Sure.
Perfect. So, as I shared, that markets have become very efficient, and it is incrementally getting very, very difficult. Even for us who are full time into markets, दिन रात यही कर रहे हैं, passion है, थोड़ा background है, CFA पढ़ी है, धंधे की समझ है, हम लोग के लिए भी बहुत difficult हो रहा है, honestly. And it's not just me. I talk to so many people, full time investors. It is actually markets have become very efficient in last 2 years. एक news आता है, by the time you analyze it, stock already उसको discount कर चुका होता है. So that way, generating alpha with each passing year has become only more difficult. Unless you are trying to time a down cycle like COVID, वो exceptional है, उसको छोड़ देते हैं. In routine, it is very difficult now. So you create alpha when you bet on change, and this is a beautiful quote by RJ in one of his interviews. He said, "You make disproportionate money when you bet on change." And what is that change? It could be change in the earnings growth of the company. So there was a company which was not growing and suddenly started growing very well, sustainably, or the quality of that earnings. So पहले एक बहुत cyclical business था, earnings आती थी, चली जाती थी, and then suddenly earnings became sustainable. Or on the market perception side, कि सबको कचरा लगता था, management चोर लगती थी, balance sheet fragile लगती थी, and so on and so forth. कभी उसको market value नहीं देता था. पीछे बहुत इश्यूज रहे, सबका बैगेज है, कोई देखने को तैयार नहीं है धंधे को. एंड देन यू notice something is happening in the business, which over time market also agrees with you. So if you identify something like this, there is disproportionate money to be made. And I think it beautifully fits Usha Martin today. अभी play out होगा नहीं होगा, God knows, but I'll just share मेरे को क्या दिख रहा है आज की डेट में. So first of all, ये बिजनेस करता क्या है? ये वायर रोप्स बनाते हैं, स्टील के. सो अभी टाटा स्टील या JSW से स्टील खरीदा, उसको ऐसे आपस में एंगल किया और एक रोप बनाया. बहुत ही सिंपल प्रोडक्ट दिख रहा है बट है नहीं. आई विल एक्सप्लेन व्हाई. जो बॉटम में आपको वो दिख रहा है वो उसका मशीन है. So it's basically tying those wires together and making a rope out of it. Extremely technical product and very critical product. So there is this 5 minutes corporate video where they show all the applications. Very beautifully made. In this 5 minutes, you understand what this company does. It's so critical and the scale at which they do. It's just extraordinary to watch this video. The problem is, in all webinars, when you play the video, they don't webcast it properly. So I'll save those 5 minutes. Ankit can share the video link with all of you later. I have taken some screenshots and let me show you.
Every day is.
Or Ankit, let's try. If I'll just play it for 30 seconds, maybe this WebEx thing might work. In other platforms, it doesn't. Let's try.
Done.
Day is a new story. Whether you're on a high-rise elevator in New York or in a coal mine in Australia, on a ride in Disneyland China, or an international seaport in the Middle East, no matter which part of the world you are, you will find us connected to your story, because today the world runs on Usha-Martin wire ropes. Our presence is in every sector, may it be in elevators, bridges, infrastructure, ports, man and material transportation, fishing, power transmission, oil and offshore rigs, critical applications of surface and underground mines, automobiles, and many more. When it comes to delivering customized solutions with value and excellence, we are one of the most trusted brands globally. Usha Martin, a multi-product, multi-unit manufacturing company with wings spread across the globe. Specializing in manufacturing of wire ropes, strands, wires, machinery, pre-stressing accessories, backed up by expert installation teams for on-site pre-stressing jobs and providing value-added services. The journey commenced with the foundation of Usha Martin's first steel wire rope plant at Ranchi, India in 1960, in collaboration with Martin Black of Scotland. The facility at Ranchi has gradually emerged today as one of the world's largest integrated wire rope manufacturing plants, presently sprawling over 170 acres. Equipped with an in-house design center and advanced machineries, supported by a highly skilled workforce and 6 decades of experience. Our manufacturing unit at Hoshiarpur is the largest wire rope unit in northern India, which was acquired in 2005 to meet the emerging demand in the market. Over decades, Usha Martin has expanded across the globe to develop closer proximity to the international market and explore new application segments. Our global R&D center, Usha Martin Italia, has been at the forefront to find innovative solutions for industry-wise technical needs. Actively engaged in the designing of wire ropes, leading to product innovations and technological advancement to provide products that are the best in class. With the incorporation of Usha Siam Steel Industries of Bangkok, Thailand in the early 80s, Usha Martin started imprinting a stronger foothold in the Southeast Asian market. Usha Siam has also entered into a joint venture that set up Tesak Usha Wire Rope in Thailand. With the acquisition of Brunton Shaw UK at the dawn of the millennium, Usha Martin created inroads into the European market. The plant specializes in the manufacture of large diameter, high quality wire ropes with applications in anchor mooring, deep sea pipelines, and high capacity cranes. Brunton Wolf Wire Ropes, our manufacturing plant in Dubai, set up in 2003, caters to the Middle East market and has eventually expanded its operations to parts of Europe and Africa, Russia, and CIS countries. To extend our global reach, the company has set up global distribution centers in the United States, Europe, Australia, Singapore, Vietnam, and Indonesia, along with authorized channel partners in South Africa, Russia, UAE, Chile, Brazil, Morocco, and Sri Lanka. In addition to the manufacturing units, Usha Martin has been continuously developing comprehensive service centers which are well equipped with world-class rigging facilities. the first of its kind. EMM Corporation, based in Aberdeen, Scotland, was acquired in the mid-90s with a focus to serve the oil and offshore market. The next edition was De Ruyter in Netherlands in 2007 to provide customized solutions for oil and offshore rigs, port cranes, marines, and general engineering industries, followed by introduction of the rigging facilities at our distribution center in Singapore. We have successfully executed several prestigious installations across the globe, including Lionsgate Bridge in Vancouver, Vidyasagar Setu in Kolkata, Naini Bridge in Allahabad, and the longest Tibetan bridge of the world in Italy. As a part of our CSR initiative, we've been actively involved in transforming the rural life of Jharkhand in India. Usha Martin is continuously committed in creating values towards sustainable development and become a global leader in industry through innovation and customer delight. A journey that spans across 6 decades and 5 continents. We invite you to be a part of this incredible journey. We invite you to the world of Usha Martin.
Ankit, how was the webcast of this video? Was it smooth?
Perfect. Perfect. I could view and listen everything perfectly.
There was no audio video lag?
No, not at all. Not at all.
Awesome. Awesome. This generally doesn't work in GoToWebinar, Zoom, or even Google Meet. I'm happy this WebEx broadcasted it well. Great. So this video showed basically what all they do, from crane ropes to mining to oil and gas, shipping. Look at that, those bridges on the top, they're suspended on Usha Martin cable. The elevators move on these ropes. The aerial trolleys, you know, when we move from one hill to another, or the material moves from in the mines, they move on these wire ropes. So this one is world's largest drag line. It's in Reliance Sasson coal mines, and these use Usha Martin wire ropes. So these are fast-moving industrial goods. As you saw, the end-user industries are practically each heavy industry, from oil and gas to real estate to automotive, mining, in terms of applications from aerial haulage, moving men and material, to elevator ropes, cranes, bridges suspended on wires, oil rigs, anchoring and drilling. How's the replacement cycle? So the shortest is in oil and mining. Basically, every 2-3 months, you have to change those ropes because of the breakage. And the longest is suspension bridges. That is like a capital good, right? अभी बैंड्रा वर्ली सीलिंग जो बॉम्बे में है अपना, या अहमदाबाद में है, कलकत्ता में है, these bridges once suspended, they last for 20-25 साल, right? They don't have to be replaced every year. On an average, Usha Martin का 2400 crore का turnover है साल का, 2400 crores. 3/4 of that comes from consumable. So no matter what, every year, multiple times, those consumables have to be replaced. Whereas the remaining 25% comes from capex and infra, which is capital goods cycle driven. अभी नया bridge बनेगा तो rope लगेगा, नहीं बनेगा तो नहीं लगेगा, right? The same bridge doesn't consume new ropes every year. Whereas in consumables, you have repeat purchase. That's why it's called FMIG, fast moving industrial goods. And personally, my favorite investment theme. So some of the prestigious projects these guys have done. Canada mein Lions Gateway Bridge hai, that's suspended with Usha Martin cables. Calcutta mein Vidyasagar Setu Bridge hai. New Guinea, Papua mein world's highest oil line is laid with their cables. So what is the entry barrier in this business? These are mission critical applications and number of stock keeping units, right? So from 4.8 mm diameters to 130 mm diameters, there are hundreds of applications in tens of user industries with thousands of stock keeping units. Very specialized, high value add product. A lot of them are customized as against off-the-shelf commodity products, thus commanding higher and more stable realizations versus other steel products. The reliability cannot be compromised at all. Imagine an aerial haulage moving men or material, or elevator carrying you and I. a bridge suspended on wires, oil rigs where cost of failure is far higher than cost of ownership. So you just cannot compromise on the quality. Hence, the approval cycle for a new vendor is anywhere between 3 to 5 years. So आज अगर कोई नया competitor आता है, जैसे ये paints में आ रहे हैं बहुत सारे, you can't just manufacture the product and sell from your existing distribution. आपको अपने factory का, अपने product का approval लेना होगा from each customer, and they will not give it overnight. In a very small sample size, they'll put your product and see it for 3 to 5 years, the safety. And once they approve, only then you can start supplying to them, which actually becomes a moat for existing incumbents, right? Because no Tom, Dick, Harry with a deep check, with a blank check can come and just displace you. Is it all ज्ञानबाजी कि यार मोट है बिजनेस में, एंट्री बैरियर्स है, या genuinely numbers में reflect हो रहा है कि वैल्यू एडिशन होता है सही में, प्रॉफिट कमाते हैं उतना? So let's see their EBITDA per ton. For Usha Martin, in last 10 years, that's as much back as I've gone. If you see, it's been in a very tight range of 12, 13, 14,000 band. This is rupees of EBITDA per ton. Compare this with a guy like APL Apollo, which claims that 70% of their products are value added. They make hollow sections. Despite being at that level, industry leader, all value added products, they make 4,000-5,000 rupees EBITDA per ton. So the value addition is highest in the industry. Compare it with any steel product you can. And why am I talking about EBITDA per ton and not percentages? Because in a lot of industries, it doesn't work percentages terms, like a Nestle or an HUL. You can't do percentages here. Abhi steel 40,000 रुपए ton है या 80,000 रुपए ton है. That will change the percentage, right? पूरा distort हो जाएगा आपका. So जो टन के भाव बिकता है उसमें टन पे ही एब्सोल्यूट नंबर देखना चाहिए. ग्रॉस मार्जिन कितना है, बिटा मार्जिन कितना है. इन लॉट ऑफ केमिकल इंडस्ट्री ऑल्सो वी सी इट दिस वे. परसेंटेजेस अभी बिटा 12,000 है और स्टील 40,000 है तो 30% बिटा मार्जिन दिखेगा, और स्टील 80,000 हो गया तो 12,000 पे बिटा मार्जिन 15% दिखेगा. So it doesn't make sense. They distort the percentages where the commodity prices are. But still, if you have to see in percentages terms, blended gross margin as on date is 45%. In value-added products, it is 60%. Value-added products are elevator ropes, oil and gas, mining ropes, port ropes, whereas commodity products are like LRPC. What is LRPC? It is low relaxation pre-stressed concrete steel. बहुत ही layman terms में let me say it सरिया होता है. वहां पे वो 20-25% मार्जिन कमाते हैं. कमोडिटी है तो बहुत से स्टील वाले भी अपना बनाते हैं, बहुत सारे छोटे छोटे फ्रैगमेंटेड प्लेयर्स भी है, और बायर इतना क्वालिटी फोकस नहीं रहता है, मार्केट प्राइस पे ही सब बेचते हैं, कंपटीशन बहुत है. सो coming to Usha Martin, these guys have 50% market share in India. They have 6% market share globally, and they are amongst the top players in the world. So you have a true blue market leader from India, and within India, a very strong competitive position. The next 3 guys or 4 guys would not even have half the market share of Usha Martin. That kind of market leadership they enjoy in India. बाप है सबके मतलब. In some sub segments, they are literally a monopoly. So you go to any port in the country, 90% of them would be using an Usha Martin cable. They are largest suppliers to world's largest elevator company, Otis. Almost all of us would have been in their elevators frequently. They are world's largest elevator company, and they are Usha Martin is a vendor to OEMs like them. Among crane manufacturers, the specification and client preference is such that even if it's a German crane guy assembling in China, the specifications are mostly so clear that let it assemble in China, but the rope should come from Usha Martin's Indian factory. That is the kind of customer loyalty and credibility this company enjoys. So the 2,400 crore turnover this company does annually, 50% is India and 50% is international. The international does not necessarily mean exports out of India because they have manufacturing footprint globally, right? I'll show it in the next slide. So the Ranchi plant is the largest. It's almost 60% of their total capacity of 3 lakhs, 3 lakh tons per annum. It was also the first plant they started with in 1960. It employs about 1,700 people, and it used to be spread over 500 acres before they demerged the steel plant. They have 2 other plants in India, in Hoshiarpur and, sorry, 1 more in India, Hoshiarpur, and 3 outside India, in Thailand, UAE, and UK. These are relatively smaller plants. The Ranchi facility is world's largest rope facility under a single roof. And as I shared, it's spread across a whopping 500 acres. So ideally, a 2,400 crore top line business making almost 300 crores of PAT, global leadership, entry barrier hai business mein, seems so good. Should it not trade at 10,000 crores market cap? And as opposed to the current market cap of 3,600 crores. Now, is it a dollar bill lying on the road and nobody's picking up thinking, yeah, fake hoga? Or is it a real note, but that's what provides an opportunity? So we need to evaluate that, right? This could be a value trap, and this could also be a great money-making opportunity. So let's see, why is it at this market cap and what is changing? So this has been completely out of radar. I'm tracking this company very closely for more than a year now, tracking it longer, invested for a year now. And in this 1 year, especially with whomsoever I've talked about it, people are not even willing to listen. That is the kind of baggage this company enjoys, I would say. Enjoys because that's an opportunity for those who are willing to ignore that and move on and see the difference. So 3 very valid reasons why everybody is not even willing to look at it. First, absolute absence of growth for last decade. The demand has been weak. The industry was struggling with oversupply at industry level, and it's practically a lost decade. No growth, no value creation, no interest by investing community, right? That's how it works. Second is, this company was at the verge of bankruptcy in 2018. They had such a fractured balance sheet. Third is, the second generation was fighting amongst each other for control. It was in a very bad boardroom control fight for better part of this decade. And it was a driverless car, yaar. So minority to पीछे बैठे थे सारे, but driver seat पे कोई नहीं था, right? And you don't want to be in a car where there is nobody nobody driving it. अभी वो automatic पे उतना confidence नहीं आया है ना. So nobody wants to be a part of a driverless vehicle. So for these very valid right reasons, nobody was willing to touch this company so far. Now let's see them one by one. What has changed? So before that, let's see how was the last decade for this company. These are segmental numbers for wire and wire ropes. The revenue moved between 1,600 crores to 2,400 crores. Based on steel prices, it went up, it went down. Very steady volumes, I would say, but the absolute numbers moved up and down. How about EBIT, the operating profit from segmental numbers? 270 crores in the beginning of the decade, 277 crores by the end of the decade, as flat as it can get, right? Let's call it a lost decade for Usha Martin and also its promoters and also its shareholders, right? But what is changing? That's past. How about this decade? If you see, the demand across the board is rebounding. The way commodities have moved in last 1 year, it is mind-boggling. It is impossible to even imagine that in the same year, oil went negative and then it crossed $100, right? And now we have shortage of oil and everybody has forgotten about ESG. Oil companies are being begged to increase production. OPEC day before said, okay, we'll increase the production. We were supposed to do it by end of the year. Now we'll do it earlier. Mining companies are having the time of their lives, and any and every commodity company is having the time of their lives, right? These are all the companies which use lots and lots of wires and ropes in their production activities. How about infra? US and Europe, the majority of infra is now 4, 5, 6 decades old. They are talking about investing trillions of dollars in rebuilding their entire infra. Real estate globally is doing well after a gap of 10 years. Every time a property is constructed and elevators are put in, you need Usha Martin cables. The category is growing at high single digits. Ports are doing very well. We know that in India. And okay, because of China, there is global export-import issues, global trade, but ports will rebound globally once things normalize. In India, they're doing well. How about global supply? That was the industry level demand. How about supply? So, in industries where you have a lot of SKUs, industry size is small, like in this case, 2400 crore का turnover है साल का, 6% market share है globally. What is the total size of the industry? It's nothing, right? It's what, 50,000 crores, just some $6-7 billion, and thousands of SKUs. In such businesses and industries, China is never interested. Same is the reason with BKT, right? Balkrishna Tire, 2400 SKUs है उसके. No competition from China. वो 100 टायर नहीं बनाता. चाइना बोलता है मेरे को मिलियन का लाइन निकालना है, तब बनाऊंगा. मेरे को economies of scale चाहिए. So the good part here is here too. In case of Usha Martin and wire rope industry, China is self-sufficient. ना ज़्यादा export करता है, ना ज़्यादा import करता है. Hardly present in the global trade, which is good, right? Otherwise, they change the equation very abruptly. Korea is a large player, but they have higher steel prices than India. Now, this is a massive advantage. If your largest raw material, which is 60% of your cost, is 5-7% cheaper in India, it is such a big advantage. By selling 2-3% lower, you can outbid your competition and yet make higher money than them. The recent 15% export duty levied on steel in India has led to an 8% correction in steel prices in India. Although global prices have also come down, but has come down by lower quantum than it has in India, widening the gap between steel prices in India and in the global markets, right? I see this as a massive tailwind, not just for Usha Martin. It is for anybody and everybody who procures steel in India, processes it, and then exports it. So your forging companies like Bharat Forge, Forging, or auto ancillaries like Jamno Auto, which buys steel and then makes the Khemani and then exports it out of India. So anybody, Khemani is the leaf spring for suspension in commercial vehicles. So anybody and anybody who buys steel in India and processes it and exports will have a 5-10% cheaper raw material, and that's such a great advantage in global trade. Now, if you zoom out and see how has the global trade been in steel in over the last 5-6 decades, it's something very interesting, and I want to stop here and share a bit about that because I personally find it very interesting, and hopefully you will also find it interesting. So steel is extremely polluting, right? And it consumes a lot of natural resources. And so what happens is when countries are developing, when the economies are still in the development phase, and they just want to increase their size of the economy and fill the global gaps, they are okay producing steel for themselves as well as for the globe, for the other countries, even at the cost of higher pollution. But as they become prosperous, they stop exporting steel to the world and just produce for themselves. And over time, they even stop producing for themselves and start importing from countries which are not too bothered about pollution or are behind in the economic prosperity curve. So if you zoom out and go back 30, 40, 50 years, Japan used to be a bigger player in steel. As it became very developed, it stopped exporting and in fact started over time importing. Then it shifted to Russia and Ukraine, and US and Europe kept importing steel and they stopped their own steel mines, steel mills. And then more recently, China was a dominant player from last 2 decades, and it was exporting a lot of steel. It had almost half the world's steel capacity at its peak. And then we know what happened. What happened in last 3-4 years to stop pollution, to curb pollution in China. They removed the tariff. They removed the incentives they were offering. In fact, uh, they introduced a lot of environmental norms and started levying uh, uh, levied started levying cost on these companies because they were polluting environment. So that's what increased the cost of steel mills in China. A lot of them got shut down also because they stopped getting subsidized power and all that, and that changed the global steel dynamics. I believe this decade belongs to India in that curve. Uh, we have the largest capacities in the world. We are in the top 3 4 in terms of steel, and we have gone through a mega consolidation in last 4 years from some 12 13 players. Now the top 3 4 players, top 5 players almost control 70 75% of the steel supply, and a lot of them through brownfield are increasing by 15 20 million tons over next 5 years, be it JSW, be it Tata, be it SAIL. And we will have a lot of incremental capacity to fill this gap which China has vacated in global steel trade. And because we have this excess supply uh, and the environmental cost and those surcharges and all that is still not too high in India. And the labor cost is also cheap, and there are other benefits. We are fully backward integrated. We have our own limestone, uh, uh, fully captive power, and so on and so forth. Our cost is uh, competitive. And now, because of this export duty, though it's not durable, it might get removed over time. But uh, the price gap with global prices is only widened. So that's my short thesis on the global steel trade, how India is placed today. Coming back to the wire and ropes industry specifically, no new large supply is coming up, and in fact, some have scaled down or shut down. How are things at Usha? So Usha, last 4 quarters has been doing amazing. They're consistently running at 85% plus capacity utilization, churning out 500 to 600 crores of top line. And now, because the demand is so good globally, and they're already running at close to full utilization, they are investing 180 crores from internal accruals to increase the value added capacity from 90,000 tons to 135,000 tons per annum. Uh, this is a jump of 50%, and it will come on stream by FY24, a year from today. What about this year? They will still manage a double-digit volume growth through de-bottlenecking and whatever spare capacity is left in the system. But come FY24, because of the new capacity and the pent-up demand, they should see a much larger jump in volumes, plus in margins, because the sales mix will change. It is entirely value-added capacity. What are value-added capacity? Elevator ropes, crane ropes, oil and gas, ports. Uh, so none of it is coming on the commodity side. It is entirely coming from value-added side. And they're undertaking a couple of other interesting value-added projects, like within LRPC, which is very commoditized, they're going for plasticization. So you invest extra $500 per ton, but then your realizations go up by $2,000 per ton. So the incremental value addition, even in commodity products, will come from this new brownfield capex. How about Indian peers? We just saw that globally, Usha is placed very well because it is leader with new capacity coming in and Indian steel being cheaper. How about within Indian peers? So there are two large listed companies, Bharat Wire and Vedmuta. If you see, their SKUs are very limited. On mining side, Usha Martin will have a blanket approval for all the products. These guys will have limited for some of their products. Both of them are debt heavy, facing working capital crunch. In fact, Vedmuta is losing money, right? And if you see their balance sheet, you talk to industry guys, raw material suppliers, they are struggling to make cash payments to their wire suppliers, the steel mills, and they're not getting any credit, working capital credit from them. Only Usha Martin is getting 2 months credit from RM suppliers. They in fact have an exclusive supply agreement with Tata Steel. So industry growth is coming back, and you have a consolidation opportunity globally because of steel price difference, and you have a consolidation opportunity domestically because your domestic competition is struggling because of balance sheet issues and working capital issues, right? So that's how I see the global and Indian demand supply scenario. So this is taken care of after a gap of a decade. The dynamics are very, very favorable for Usha Martin. How about balance sheet, which was completely fractured back in 2018? So this is how this company looked in 2018. Lot of flab, right? You can surely get rid of that excess. And what a transformation in a span of 4 years, right? Uh, it is debt free today. Now it's magical. How did they manage to pull this through? So it was very simple. What they did was they had actually in last decade done a backward integration. Steel mill से steel wire खरीदते थे और rope बनाते थे. इनको लगा यार rope wire ही अपना बनाते हैं. So they started a 1 million ton steel mill, fully backward integrated. अपना mine, अपना power और मस्त 4-5 हजार करोड़ debt लिया, and they were going through a down cycle. We all know what happened to steel in 14, 15, 16, 17. It was one of the worst down cycles. Even the lowest cost producer like a JSW struggled. Then these guys were a subpar 1 million ton scale. It was nothing. And because of this, backward integration backfired and all the leverage was literally making them go bankrupt. They had to decide. They had to get rid of one business, either the steel mill or the wire rope. The wire rope was on the block, but they did not find a buyer. They could find a buyer of the steel mill, and Tata Steel bought it. Tata Steel mill obviously got very lucky. At the bottom of the cycle, they got such a good asset at a throwaway valuation. That aside, anyways, now they have a supply agreement with Tata Steel, and they also have two other large mills in the same vicinity, Ranchi plant ke paas. Ranchi is the steel hub. JSW का भी plant है. So raw material is assured, right? So the second is taken care of. They are thriving. Balance sheet is debt free. They are generating a lot of cash. पूरा capex internal accrual से हो रहा है. It is in the best shape ever, their balance sheet. How about the third one? So these are the two second generation folks, sons of two promoters who started this company, Rajiv and Prashant. Rajiv owns 31%, Prashant owns 15%. And these two guys were in a fierce boardroom battle for better part of this decade, and they were fighting for control. And hence I said there was no driver in this car. But Rajiv took side of the SBI-led consortium, who was the lead lender to this company, and they sold the Tata Steel. They sold the steel mill to Tata Steel and ousted Prashant and his father from board. Now Rajiv has the entire control of the board. He is the continuing promoter. Prashant is practically a public shareholder now with no representation in the board or operations of the company. So this is completely done and dusted. Now you have one promoter who is an owner operator, who has skin in the game and doing all the right things for the business, which should have been done earlier. Three very big turnoffs because of which nobody was looking at this company. To my mind, all three completely taken care of. What are the triggers in the story now? So the near term, from last 1 year, we were anticipating this, and it played out beautifully. So this company had a lot of accumulated losses because of steel. Obviously, those losses went to Tata Steel, and they'll benefit by saving taxes on that. But even here, net worth was completely almost eroded. And they had to, now they were making 250 and 300, almost 300 crores of cash flows every year from last 2 years. But they were not able to pay out any dividend because the equity was negative. So they had to reorganize their capital. They took shareholder approval, NCLT approval. It took them almost a year. And just last month, they got this approval and they paid a dividend after a gap of 9 years. And this maiden dividend, so to speak, of the new entity after it transformed was a whopping 62 crore rupees. Even at CMP, it translates to 1.75% dividend yield, right? So capital allocation, to my mind, promoter is demonstrating he's mindful of capital allocation and he's taking it very seriously. The second is, as I shared, the brownfield capex will increase the capacity by 50%. Even this year, through debottlenecking, we are anticipating double-digit volume growth. And volume growth is most important because steel prices will go up and down, and the absolute top line will mislead you. You have to just focus on volume growth, and they share volume growth through investor presentation every quarter. So we anticipate volume growth in double digits for next 3 years. FY24 being one with step up growth. A better product mix will ensure margins go up. It's entirely the capex is value addition products, and LRPC is also improving in value. What are the long-term triggers? The next gen promoter, the continuing promoter, has 3 daughters, and nobody seems to be involved in operating business. Potentially, this could be an M&A target, and in the hands of a larger global, more professionally run company, this could be valued much, much more. It has been completely out of radar. There is zero sell-side coverage on this business. There is no ownership by DI or FII. A couple of YouTube videos might have come recently. We have already made this on our guest dashboard. I'll share how we have shared a lot of public resources in the last few months on this, which was followed by a couple of YouTube videos and some Twitter threads. But prior to that, practically, we did not meet anybody who was talking about this. And even when we were talking about this, there was no interest. The good part is that management is opening up to investors now with the dividend being resumed at a very healthy rate. We understand they are in the process of shortlisting some IRs, and con calls might start in 1 to 2 quarters, which is when a lot of visibility could come companies' way. Look at how P&L is also transformed. So this was back in 17-18. They used to lose money at EBITDA level. They had a 500 crores of net interest cost. Obviously, at net level, they were losing 350 crores. Market cap was about 1,000 crores. This was their transformation phase. This was their turnaround phase. In FY22, they generated 375 crores of EBITDA, no interest cost as they're debt free. They reported a profit of 270 crores. This is normalized profit. Reported profit is about 300 crores. There was a 30 crores one-off gain. ROE is 17%. Trades at a price to earnings of 13 times, translating into a market cap of 3,600 crores. Okay. This is how I anticipate 2025 to be. The operating profits can be as high as 600 to 625 crores. They will have net income, other income of 50 crores. Net profit could be about 400 crores. ROEs shall expand by 500 basis points because of sales mix change, margin expansion, and being brownfield expansions, there is scope of operating leverage as well. I think for such a business where you're market leader, you're growing, you're debt free, you're paying out decent cash, you're making more than 20% ROE, and there are entry barriers in your business, and you're in a upcycle, 18 to 20 times is a reasonable multiple to my mind, given the characteristics of this business. And with those reasonable assumptions, I think the market cap can be anywhere between 7,000 to 8,000 crores, which is twice the current market cap. A big re-rating trigger being the payouts, which can double over the next 2-3 years. My assumptions, mind it, are reasonable. There are some working capital optimization scope, which I'm not considering here. Their international operations have 6 months of working capital. Because of COVID, it has been really stretched. Once logistics issues normalize, I expect working capital to be further optimized, and that can add 150 basis points to my ROE assumptions, ROC assumptions. So my number assumptions, to my mind, are reasonable. At an exit multiple of 18 to 20, we stand to more than double our money in next 2.5 years. What are the overhangs? No investment opportunity is free of risks. Things can always go wrong. And it's a luck whether things go right or things go wrong. So one is the ousted brother has been dumping shares regularly in the market. A year ago, when we invested in this company, he had 21%. Today, he's down to 15%. His two entities are called Peterhouse Investments and Usha Ventures. Unfortunately, these entities are still under promoter category, although they are not operationally or board-wise, they don't have a position. So every time they sell, you get a notification promoter is selling. So, it's an overhang. For those who don't understand, there are two groups now. One is out and he's practically a public shareholder. And obviously there is an overhang in the supply standpoint. There's always a supply waiting at every price to sell. So he's been selling from $50 all the way to $160. Today's stock is 117. Despite all the selling, the stock is up more than 100% in last 1 year. So he's been calibrated with his selling, but nevertheless, there is that overhang. The other is this balance sheet has a 400 crore contingent liability. The case seems very strong. There is no willful wrongdoing. They've already won at Jharkhand High Court level, and management seems confident they'll eventually win. We have tried to understand the case in detail and spoke to some stakeholders, and we understand they have a very high, almost certainty to win this case. Just like there is export duty levied on steel, raw steel, can it be levied on steel products also? That is a risk, right? Because if that happens, then globally you're no more competitive. To my mind, it's unlikely, because if I did not help you in your bad times, I cannot punish you in your good times. The steel industry was helped by government in bad times by levy of import duty. When there was global dumping of steel in India, right? We protected our domestic steel mills. We did not protect our steel exporters, these steel product exporters. They still had to buy expensive steel because of that import duty. They could have imported cheaper steel, but because there was an import duty, you increased the cost for them and you did not provide them any aid. Now, in good times, when they can buy cheaper steel domestically and export, how can you levy export duty on them? To my mind, it's very unlikely. It doesn't make economic sense. The chances of this happening are very, very thin. So to recap, let's just go through some hygiene and risk factors. You now have a global business which has mastered one skill and mastered it really well. No conglomerate, no backward integration, no forward integration, no drama. One product you make it really well. You have domestic leadership, you have global leadership, and you do it really well. You have a robust debt-free balance sheet, consistently generating 200 plus crores of operating cash flows. You pay tax at full rate. Despite being a B2B business, fairly diversified, top 10 with less than 35% of sales cumulatively. You have one of the big fours as auditors. Your capital allocation seems good with 25% payout and rest all being reinvested in the business for growth, not hoarding cash, not doing hanky-panky with it by investing it here and there. reinvesting in the core business, and paying out the rest. Capital allocation as good as it can get. No obvious leakage. Looking at the financials, the reported numbers are really good and backed by cash flows. The continuing promoters own 31% stake, so there is skin in the game. I don't think there is any other operating business for them outside of this entity. And also the continuing promoters, being Rajiv and family, they've been buying from the open market last few days. So while the ousted brother and his family are selling, the continuing promoter is showing confidence and demonstrating confidence by increasing his stake and doing all the right things for the business. You would notice on screener that half of the promoter stake is pledged, but mind it, it's only procedural in nature. They're already debt free, and it will soon go away. So in summary, for us, it's a case of variant perception because Dalal Street still perceives UML as a subscale steel mill with a fractured balance sheet and ruined by inter-promoter tussle. Whereas for us, or let's say in reality, UML is an FMIG, the most classy business on the B2B side, which is fast-moving industrial goods, with a moat, an entry barrier, entering a growth phase where earnings should compound at more than 20% for next 3 years, with an improving return ratio where we should see a 500 basis point expansion on ROE side, a completely transformed balance sheet, which is debt-free and net cash, optimal capital allocation with a quarter of free cash being paid out, and yet available at 13 times trailing earnings. Some additional disclosures and view at CMP. So this is part of Stalwart Advisors Treasure Trove Research Service, which is like a model portfolio. Personally, too, it's a core position for me and my family. We initiated buying at 56 last year and have been averaging up all the way, although no transactions in last 30 days. I would personally not hesitate in building majority of the position at CMP of $117 and look to add on dips. Why would I build majority position at CMP? Because the incremental risk reward and upside remains healthy at current price. My incremental return expectation from this price is about 100 to 125% in 2.5 years, which is in the top quartile for our research coverage. So I'll just end on this slide. This is part of our guest dashboard, which doesn't have any paywall. So if you visit the URL on the top, stalwartvalue.com, on the website, you will see a green button called free sign up. Once you log in, you will see under Treasure Trove, we have our initiating coverage report titled Rising Like a Phoenix on Ushamartin. And you'll also, once you scroll down, you will see that we have a lot of updates published over last 1 year. So recently we had a call with the management where we got a lot of interesting inputs on the business. That is part of this dashboard. We attended last year's AGM, and that is also part of the dashboard. So all of this is available on guest dashboard. There is no paywall. If you find the opportunity interesting and you want to dig deeper, you could always visit and check it out. With that, Ankit, I think I am done with my part. We can open for the Q&A.
So much, Jatin. This was really, really helpful. And I have lots of questions, but I think I have to first go with people who are already raising their hands. So I think Avadut has been raising his hand for a long time. So Avadut, you can go ahead with your question.
Hi, good evening. Thanks for the wonderful presentation, Jatin bhai, and wonderful insights. 3 questions. First is, as far as I understand, they have design plus process and product. All 3, they have advantage, right? Because, and if I understand correctly, for each application, they have to design these wire ropes differently, right? And the material composition will change accordingly. And is that the correct understanding?
Hi, Avadut. Yes, that's correct understanding for some of the value-added products, not for all. A lot of it is off the shelf, also standardized stuff. But if you see on this slide, they have two R&D centers in Italy and India, and a lot of these designs they do in-house in collaboration with customers. Sometimes customers own the patent and they just do the manufacturing part. Sometimes they retain the copyright for what they have designed in-house. All in all, this involvement in R&D makes the customer relationships very sticky, and once the product is set, they tend to keep coming back to you, because for them, in terms of cost, is nothing, right? In larger scheme of things, imagine in an oil rig, if something goes wrong and your rope falls apart, it'll take a few hours to get the operation back up and running. And the amount of loss you can't even imagine compared to this cost of rope will be thousands of times, right? So
Correct.
the cost of failure is so high that there is simply no incentive to change your vendor if everything is working fine. So that kind of adds to customer stickiness and makes it a kind of a moat for them.
And plus your intangibles get developed. You are working on those products which patents are with customers, and you work on process plus design. Your intangibles get developed, and in near future you can cross sell it to another customer.
Absolutely. And if you noticed in the video, you know, from the face of it, ऐसा लगता है यार क्या है वायर रो पे आपस में entangle कर रहे हैं, कितना SKU बना लेगा. But I have seen the catalogs, it's just mind-boggling. And in the video, they have shown the processing, right? Factory के बहुत सारे shots है, manufacturing के. The SKUs are upwards of 1,000, and a lot of them are specialized, like you said.
As you mentioned that SKUs, it immediately came to my mind BKT or the RCL GearTech or AIA kind of business it is.
Absolutely.
And the second question, the growth can come from the geographical expansion. You mentioned first about the product mix change, which could be in favor of value-added products, but the geographical expansion will also give them a fillip. So whether they're working for the geographical expansion, they have presence in different countries, but the volume seems to be low there. Any plans to increase volumes over there? Or
so in terms of manufacturing, they'll not increase elsewhere. Those are high cost geographies. In terms of the cost, the power cost, labor cost, taxation, everything is far higher outside India. They have that benefit here. They are increasing all the capacities in India, and they'll export out of here. Raw material availability and raw material cost is also favorable in India. But from a sales standpoint, to my mind, majority of the incremental capacity will be used for exports, almost 2/3. And a lot of it is captive, organic, in terms of your oil and gas customers drilling more oil, so they need more ropes. Mining activity increasing, so they need more mining. And the open cast mines are also more, the replacement cycles are faster, so on and so forth. And then they're also targeting some new geographies. The last I understood for them, they were targeting Russia, but then this happened, Russia-Ukraine war. So that has taken a bit of a backseat right now. But that's a large market with big entry barriers. They've made some inroads, to my mind. And once things settle down, that can be a growth opportunity for them.
And commodity-rich countries like Australia could be another market for them where they can make it.
Correct. A lot of mining happens there. So that ways, it must be a large market for them. Absolutely.
And to track things, you mentioned about volume growth is the one and the product mix change. Any other things that you can
These are the things that matter, Abdut, right? And they share everything in investor presentation. And we just need to wait for a couple of quarters. I think they're very serious about starting con calls. So other things we'll get to know once they start being more open and regular with larger investment community.
Okay. And last thing about the company, what are the things that come to your mind that can go wrong? One is the capex cycle not picking up can hurt them. Any other point that can go wrong? Yes.
See, if you think very long term, then anything related to oil and gas has a headwind, right? Terminal value risk है. अभी 2030, 2035, we don't know कब होगा, लेकिन जब भी EV हो जाएगा, transition. So anything to do with oil and gas will have a terminal value risk. So that is one. The other is, like you said, पूरा capital goods cycle ही अगर globally बैठ गया, we enter a recession because the inflation has been crazy, and to handle that, instead of addressing supply side, we are trying to kill the demand by increasing interest rates. So उसका unintended consequences तो होना ही है. So if we enter recession and your capex cycle goes for a toss, and your overall demand in mining, oil and gas because of recession also goes for a toss, तो कंज्यूमेबल साइड भी लगेगी और कैपिटल गुड साइड भी लगेगी. सो ग्रोथ नहीं आएगी, बट एक स्टेडी बिजनेस है. सो दिस इज एन एफएमआईजी बिजनेस, राइट? यू सॉ दिस स्लाइड वेयर आई शेयर्ड देयर 10 years ऑफ डेटा, राइट? अभी ये 10 साल क्या था, बिजनेस में कोई ध्यान नहीं दे रहा, प्रमोटर्स में लड़ाई चल रही है, मैनेजमेंट का भी क्या ही फोकस होगा बिजनेस में, है ना? बिकॉज
Correct.
प्रमोटर नहीं है, तो मोस्ट ऑफ मेनी ऑफ एम्प्लॉइज कुड हैव लेफ्ट, कोई मोटिवेशन नहीं होगा. एंड डिस्पाइट ऑल दोज इश्यूज, बैलेंस शीट की लगी हुई है, कंपनी बैंकरप्ट हो सकती है, nobody is driving the company, and yet look at the sales, it has been so steady. And mind it, this was also a very bad cycle for the industry. Oil and
Yes.
gas from 2013 till 2020 has been through a very bad phase.
Correct. They have not put up
Mining
capital.
has been through such a bad phase, right? So ये एक इतने खराब फेज में भी with no focus they maintained top line, they maintained EBIT, shows that एक steady base business है which is not going anywhere, right? So अगर अपना थीसिस फेल भी हो जाता है तो ग्रोथ का चैलेंज आ सकता है, बट मुझे लगता है जो बेस बिजनेस है, इट इज नॉट गोइंग एनीवेयर फॉर एटलीस्ट नेक्स्ट 5 years. And at this multiple, when you have a base business which is throwing out 250-300 crores of cash and you're getting 60-70-80 crores as dividend, 3,500 crore market cap, your downside should ideally be extremely restricted unless some other skeleton from somewhere comes out. Fingers crossed, I hope that is not the case. But otherwise, मुझे risk में downside नहीं दिखता, but my upside case can go haywire if things go wrong.
Understood. Thank you. Thanks for the elaborate explanation. One question on the turnarounds or the philosophy where what you use over there in management change. Do you have, as you said, do you have a avoid list over there or a checklist to avoid? Like we considered the example of Indiabulls real estate, which is asset heavy. Currently, they are having huge assets on the book. So, do you avoid asset heavy business and you focus on the asset light business? Any kind of such checklist do you prefer? Because I have used your checklist on cyclical business and it has been immensely helpful for me. And thanks a lot for that, uploading it.
Most welcome, Avdut. I'm glad that helped. In terms of asset heavy, asset light, see, if you make these rules now, then you confine yourself too much. It's good to have rules, but you need to strike a balance, because otherwise you'll miss out on a lot of opportunities. Everything is okay at a price here. Asset light is good, but at a price it can be very unattractive. And asset heavy is generally undesirable, but at a price it can be very desirable.
Okay. To avoid the surprises, do you have any checklist over there in the turnarounds?
Yeah. There are certain balance sheet things, certain promoter level issues, and you have your own forensic you run on each. So those basic checks and balances are all there. So 3,000 कंपनीज में से 200-250 ही है जिसको एक्टिवली ट्रैक करते हैं, जो वो सब क्राइटेरिया मीट करती है. उसमें से 20 पोर्टफोलियो में है. सो all the rest you filter out based on your checklist and forensic कि इसको किसी भी भाव पे नहीं लेने का.
Okay. Understood. Thank you. Thanks a lot.
Most welcome.
Avdut, for some great questions, and thank you, Jatin. I think we have one more question from Kailash. So Kailash, you can.
Ankit, just give me a sec.
Anybody else has any question? I have a long list of questions. I can go on and on, but I think we'll have to take Jatin's question, permission.
Ankit,
How much time?
Ankit, I wish I could spend more time, but I am so sorry. I had a hard stop at 6. My family is
problem.
waiting. We had to leave for somewhere.
No problem.
I'm pretty active on Twitter. My DM is open. My email address is jatin@stalwartvalue.com. I'll be happy to take any questions offline, or if there are too many of these, we can have one follow-up session and we can have half an hour for Q&A some other time. Right now, I have 5 minutes. We can quickly take a couple of questions if there are any.
Kailash, you can unmute yourself and ask your question first.
Yeah. Hi, sir. Good evening, sir. Am I audible, sir?
Good evening. Yes, you're audible.
Yeah.
Please go ahead.
Yeah, sir. Now, actually, this may not be a question. Actually, I had gone through the qualification, that is, CFA and MBA. So my elder daughter, actually, this may be a kind of a seeking advice. Now, sir, the point is, she has done actually BA economics, and she's in the race of gold medal. So maybe an ACCA she has completed, and she's quite brilliant and had scored AR1 in few subjects, and she has completed CFA level 1 and CFA level 2. She will be attending. So my question is, sir, in the past, actually,
Kailash,
we
I'm
had
so
observed.
sorry to interrupt. Since this is unrelated to presentation, can we please
Okay.
take this
Okay.
offline? You can
Yes.
drop me an
Yes, sir.
email and
Yes, sir. Yes, sir.
I promise
Yes, sir.
I'll get back.
Absolutely.
Kailash,
Absolutely, sir.
by any chance, were you there in Gujarat Ambuja's and AGM few years back?
Yes, yes, sir. Actually, I am, actually, actually, it was also one of the example of, actually how
Yeah,
the
I remember
management
your
perception.
voice. I remember your voice. Perfect. I am on
Okay, sir. Okay.
jatin@stalwartvalue.com. Please drop
Okay.
me an email. I'll surely get back to you
Yeah,
on
definitely, sir.
clear guidance.
Definitely.
Yes.
Thanks a lot, sir. Thanks a lot. Yeah.
Most welcome.
Thanks a lot.
Jatin, in the interest of time, I'll just have one question from my side. As in, if you can elaborate a little on the contingent liabilities side, and also share a little bit about who are the global players as their competitors, because they have 50% of their business from international market, right?
Perfect. Both are very interesting questions, Ankit. I, in fact, had I should have them in the annexures. Let me open it. Yeah. So between 2006 to 2010, what they did was, from their iron ore mines, in addition to the iron ore, they were also selling iron ore fines. It was part of the mine. It is allowed as per the mining agreement. They disclosed it in the mining filings, and they also paid royalty on that. So कोई चोरी नहीं थी, जो कर रहे थे दिखा के कर रहे थे, और पूरी दुनिया कर रही थी. Everybody at that time from their iron ore mines was doing that. Now, out of nowhere, the regulator said that this is not allowed and you have to pay fines on that. The other fine on fines. Yeah. By selling iron ore fines, you have to now pay fine, and that is worth 400 crores. So उसमें पूरा CBI का इंक्वायरी स्टार्ट कर दिया, इनका लैंड अटैच कर दिया रांची का 190 करोड़ का, विच इज वाई टाटा को अभी वो लैंड पार्सल पूरा नहीं गया और टाटा से 100 करोड़ आने हैं. It's 160 now, its residual is just 90 crores, 70 crores और आ गया है. So they are very confident. हमारे अग्रीमेंट में लिखा था, हमने उस पर रॉयल्टी पे किया, हमने डिस्क्लोज किया था, हम ही नहीं सभी जन करते हैं उसको, और हमने दिखा के किया, हमने कोई चोरी नहीं करी. और झारखंड हाई कोर्ट में ऑलरेडी जीत चुके हैं केस. सो टू माय माइंड दिस इज जस्ट bureaucracy. It will take its own time, but they should come out clean from this. Actual liability कुछ नहीं होना चाहिए, contingent ही है. Your other question was global competition. I should have a slide on that. Yes. So globally, if you see, Bryden and Kiswire are the largest. Kiswire is Korean. And then there is Wireco also. These three are the largest, followed by Usha, Redeli, and Hegi. This is in oil and gas. In mining, again, similar names almost. Couple of them are listed also. If you see, Kiswire is listed, Bryden is listed, and but some of them are more diversified, So apples to apple comparison become difficult. But overall, it's a good business. People make money. Industry is good. It's not very competitive, like cutthroat competition. People are losing money, cutting each other's neck. ऐसा नहीं है. पैसा बनता है इसमें. अच्छा business है. And with market leadership and cost leadership, Usha, I think, is better placed versus these global guys.
Jatin, thank you so much for your answers. And before we let you go, just one comment which I wanted to share with you regarding Usha Martin. My Nana ji has been their supplier for cable drums for many years. So I have not checked up with him recently, but I remember 2 years back, he was very fed up with the payments. So that payment was taking a lot of time. But after looking at your presentation, probably the first thing I'm going to do is I'm going to pick up my phone and call him and try to understand, because he's one of their oldest suppliers of cable drums, and he has a very good relationship with the management.
Great. I would be very curious to know the feedback you get.
Right, right. So
Great.
thank you so much, Jatin. Just before leaving, if you have any closing comment to make, that would be really good.
Markets are volatile, so I would just say that sometimes the up and down prices play too much with our psychology. When prices go down 20, 30, 40%, the conviction also tends to go down. It is difficult, but it makes sense to focus on the business rather than the price, and not jump out of the ship just because the price is going down. It pays to stay invested in businesses through bad times if our thesis is intact. So I would want to leave everyone with that thought that if we focus less on stock prices and focus more on underlying businesses, it will do us really good.
Thank you so much, Jatin. Thank you so much for this presentation, and I'm sure, just like me, everybody enjoyed it.
My
I will just
pleasure.
request
Thank
you
you.
to, I will just request you to email the presentation also, so that we can put it there.
I'll do that. I'll do that.
Okay.
Thank you everyone
Thank you.
for joining in. I hope
Thank you,
this was
everyone.
worth your time. Thank you, Ankit, for hosting me. And if there's anything, I can be contacted on jatin@stalwartvalue.com.
Thank you. Thank you, everyone. Thank you.
Thank you.